So picture this. You've spent, what, like 25 months building it?
Oh, yeah, just endless nights of Python and data scraping.
Right, exactly.
Yeah.
You're sitting at your desk, the glow of the monitors is lighting up your face,
Mhm.
and you are looking at what you genuinely believe is just an absolute masterpiece.
The holy grail of algorithms.
Yeah. I mean, you've fed this algorithmic trading strategy every single tick of data for Ethereum against Tether ETHUSDT, right?
Mhm.
You've refined all the entry triggers. You've meticulously balanced the take profits. And the backtest dashboard is just printing numbers that look like a staircase to infinite wealth.
It's the exact kind of equity curve that makes a quant developer think they're about to retire in their 30s.
Totally. We are talking like a plus 55% profit and loss.
Which is huge.
Huge. And it's making around 500 trades, so, it's not just getting lucky on one random macro swing.
Right. It's actually doing the work.
Yeah. And your maximum drawdown, the absolute worst plunge your account would have taken from a high to a low, is this microscopic, negative 0.9%.
The line on the chart just marches beautifully from the bottom left to the top right, like barely a ripple in it.
Exactly. And if you're a rigorous developer, you didn't just look at the raw returns and, pop the champagne.
No, of course not. You did the hard math.
You ran plateau analysis. You made sure your parameters were sitting in the middle of a wide, stable, flat mesa on a 3D topographic map of returns, right?
Yeah, rather than being balanced precariously on some jagged, fragile peak where a tiny breeze of market change would just send you plunging into a ravine.
Right, exactly. You ran walk-forward testing. You ran Monte Carlo bootstrap simulations to make sure, a random string of bad luck wouldn't bankrupt you.
And the dashboard is just entirely green.
All green. So you changed absolutely nothing, right? You take this masterpiece and you launch it on Solana.
Oh, man, here it comes.
And within 3 seconds, you lose 12% of your net worth.
And pure panic sets in.
Pure panic. You think, okay, maybe Solana's just weird right now.
Yeah.
Let's try it on a Dogecoin.
Which is always a completely rational choice.
Obviously.
Yeah.
So you point your pristine, mathematically proven algorithm at DOGE, and it immediately tanks by 34%.
Brutal.
In a matter of hours, the entire illusion of your perfect trading strategy just shatters into a million pieces.
Welcome to the single symbol trap.
Yeah, seriously. So we're doing a deep dive today. And our mission is to unpack this massive stack of research we got on algorithmic trading validation.
Specifically focusing on some really eye-opening concepts from the Backtest Without Illusions series.
Right. We want to deconstruct the single symbol trap and really get into the methodology of multi-symbol validation, because we need to figure out how to mathematically prove whether a trading strategy actually has a real market edge, or if it's just, essentially perfectly fitted to the past behavior of a single coin.
And, for you listening, whether you are actually risking capital or you're just trying to understand how quantitative finance works, you really have to know the difference here.
Because it's a huge difference.
It is the only thing standing between capturing a true market inefficiency and merely curve fitting to the random, chaotic noise of one asset.
Okay, so let's get into section 1. The illusion of the perfect algorithm. Why is a strategy optimized on a single instrument, like ETH, fundamentally flawed from the start?
Well, it goes back to that visceral, gut-wrenching feeling of watching a perfect backtest disintegrate. The immediate psychological reaction is usually denial.
Yeah, there's a bug in my code.
Exactly. The trader assumes there has to be a bug in the Python code, or maybe the exchange API is dropping packets, or the historical data feed had a glitch, because, the math proved the strategy worked, right?
Right. It survived walk-forward testing. It survived Monte Carlo.
But the math was answering the wrong question. And to understand how we fall into this trap, we really have to pull apart those traditional tests you mentioned.
Okay, let's do it. Walk-forward optimization. What is it actually doing?
So when a developer runs walk-forward testing, they are essentially taking their historical data, chopping it up into chunks, optimizing on one chunk, and then testing on the next consecutive chunk.
Basically asking, if I learn the rules in 2021, do they still make me money in 2022?
Precisely. They are checking robustness across the axis of time. They are verifying chronological stability.
Okay, that makes sense. And what about Monte Carlo?
Now, the Monte Carlo bootstrap test, that takes all your historical trades and violently shuffles them like a deck of cards over and over again to simulate thousands of alternate realities.
So it's testing trade order. It's asking if I flip a coin and get tails 10 times in a row, meaning I hit all my historical losing trades back to back, does my account still survive?
Yes, exactly. It tests the axis of sequence. And both of those tests are mathematically rigorous and honestly absolutely vital. But notice the massive blind spot here.
Neither of them evaluate robustness across different instruments.
Right. They never ask the fundamental question. Does the underlying logic of this strategy rely on a universal market truth, or does it only work on this one specific asset?
Wait, let me wrap my head around this. So if I build a momentum strategy on Ethereum and it survives the time test and the sequence test, you're saying it hasn't actually learned how to trade momentum.
It hasn't learned a universal law of momentum, no. What it has done is essentially memorize the highly specific, incredibly granular structure of Ethereum-specific price series during the specific window of time you provided.
Wow. So it's like it memorized the answers to the test instead of actually learning the subject.
That is a perfect way to look at it.
Yeah.
The algorithm tuned its internal thresholds to perfectly match Ethereum's historical volatility. It adapted its moving averages to the exact cadence of Ethereum's candlestick patterns.
Right.
It molded itself to the specific liquidity quirks and order book depths of the ETHUSDT pair on whatever single exchange you pulled the data from. It even anchored its logic to the exact way Ethereum was correlating with Bitcoin during those 25 months.
And none of that is a universal market edge.
Exactly. That is just curve fitting at the instrument level.
Okay, I have an analogy for this. It's like training for a marathon, right?
Yeah.
But you decide to train exclusively on a perfectly flat treadmill inside a totally climate-controlled gym.
Oh, I like this.
Yeah. So you spend 25 months dialing in your heart rate, your stride is mechanically flawless, your breathing technique is, perfectly optimized for 72 degrees and zero humidity.
You're a machine.
Exactly.
Mm-hmm.
You look at your Apple Watch and you think, I am a world-class runner. But the absolute second you step outside for the actual race and you hit a steep hill or some wind or freezing rain, your quote-unquote perfect running strategy falls apart completely.
And in this scenario, Solana and Dogecoin are the freezing rain and the steep hills. You optimize your algorithm for a strictly controlled environment, but the broader crypto market is wild, varied, and totally uncontrolled.
Okay, but I want to push back on that analogy for a second, because I think a lot of people listening might have the exact same thought I'm having right now.
Let's hear it.
If we're saying other coins are the outside weather, how different are they, really? I mean, a chart is a chart, right?
Yeah.
Whether I pull up Ethereum or Solana or some random meme coin my uncle texted me about, they all just look like green and red candlesticks going up and down. Is the environment genuinely that alien?
See, that assumption right there, that a chart is a chart, is exactly what kills retail algorithms.
Really?
Oh, absolutely. To do multi-symbol validation properly, the research insists that you have to completely throw out the idea that the cryptocurrency market is a monolith. It is not one single ecosystem with identical physics.
Okay.
The market is aggressively segmented into 4 distinct tiers, and these tiers possess fundamentally different microstructures. If you don't understand the physical differences between these tiers, validation is basically impossible.
Okay, I want to map this out. Let's physically describe these 4 worlds so we can understand why an algorithm breaks when it travels between them. Let's start at the top.
Sure. So the top of the pyramid is tier 1. These are the blue chips. In the current landscape, we are primarily talking about Bitcoin and Ethereum.
Right.
The defining characteristic of tier 1 is massive, continuous institutional capital flow.
So this is like the deep ocean.
The deepest. Because of that immense volume, the daily volatility is actually quite low for crypto standards, usually hovering around a 2 to 4% daily swing.
Okay, that's pretty manageable.
Yeah, but the most critical factor for an algorithm is the liquidity. In tier 1, you might have $5 to $50 million of resting orders sitting right there in the top 5 basis points of the order book.
Oh, wow. Meaning I can buy or sell massive amounts of Bitcoin without the price suddenly jerking away from me.
Exactly. The market absorbs your order effortlessly. And consequently, the spreads, the gap between the highest buyer and lowest seller, are incredibly tight, usually around 0.01% on perpetual futures.
That's practically zero.
Pretty much. Furthermore, tier 1 assets actually care about the real world. They correlate heavily with macroeconomic factors. They react dynamically to the S&P 500, the strength of the US dollar, and the Federal Reserve's interest rate decisions.
Okay, so tier 1 is the metropolitan city center. It has heavy infrastructure, massive traffic, and it plays by global economic
The
rules.
perfect way to frame it.
So what happens when we drive out to Tier 2?
Tier 2 consists of the large caps. Think of assets like Solana, Binance Coin, Cardano, Avalanche. The environment here is slightly more volatile, stepping up to maybe 4 to 6% daily swings.
Okay, a little bumpier.
Yeah, and liquidity is still strong, but it's noticeably thinner than Tier 1. You might only have $1 to $10 million sitting in the tightest part of the order book. Spreads widen a bit, perhaps to 0.05%.
If Tier 1 is watching the Federal Reserve, what is Tier 2 paying attention to?
Good question. Tier 2 is largely driven by internal crypto sector dynamics and technological narratives. You'll see capital rotate based on the competition between Layer 1 networks or the rise of new Layer 2 narratives.
Oh, like when everyone was hyping up alternative smart contract platforms?
Exactly. Their correlation with Bitcoin is still quite high, usually a statistical correlation of 0.6 to 0.85. But they definitely have a mind of their own depending on the current news cycle.
Okay, so Tier 2 is the suburbs. Manageable, a little more spacious, slightly different rules. But let's keep driving. Let's talk about Tier 3, because this is where the wheels usually fall off the wagon.
Right. Tier 3 is the mid-caps, and this is an entirely different behavioral landscape. We're talking about Dogecoin, Shiba Inu, Pepe, Arbitrum, Optimism, a mix of massive meme coins and highly narrative-driven tokens.
The wildlands.
Very much so. The daily volatility here jumps aggressively to 6 to 10% on average, and their price action has almost zero correlation to fundamental macroeconomic factors.
So they don't care about the S&P 500 at all.
The Federal Reserve could raise rates, and Tier 3 might ignore it completely, because their movements are dictated by viral social media trends, sudden exchange listing rumors, and, fleeting internet attention spans.
And mechanically, how does that actually affect the algorithm trying to trade it?
Mechanically, the order books become dangerously thin. You might only have $100,000 to $2 million of true depth near the current price.
Oof, that's a huge drop.
Yeah, and because it's thin, the average spreads gap up significantly, often to 0.15% or higher. Most importantly, their statistical correlation with Bitcoin drops off a cliff. It can fall down to the 0.3 range. They are practically untethered from the anchor.
Which leaves Tier 4.
The low caps. Brand new token generation events, fresh exchange listings, microcap projects. This is the absolute frontier.
Total Wild West.
Exactly. Daily volatility routinely exceeds 10 to 20% or more. The order books are astonishingly shallow, maybe only $10,000 to $200,000 of depth.
Wait, really? So a single wealthy trader can essentially just muscle the price wherever they want?
They absolutely can, and they do. The manipulation risk in Tier 4 is extreme. The charts are filled with massive violent wicks, spoofing in the order books, and rampant wash trading.
Sounds like a nightmare.
It is. Spreads can be a massive 0.5% or more. Funding rates for futures contracts can swing wildly. The correlation with Bitcoin is practically non-existent, and crucially, from a data science perspective, you almost never have more than 6 months of historical data to even test on.
All right, hold on. This brings up a massive logical roadblock for me.
What's that?
If Tier 4 is basically a lawless wasteland where the order books are an illusion, the history is basically non-existent, and a random whale can swing your portfolio 20% in an hour. Shouldn't a rational algorithm developer simply ignore Tier 4 entirely?
That's an incredibly valid point.
Right. I mean, if my goal is to build a steady, reliable hedge fund, why on earth would I waste my time trying to validate a sophisticated mathematical model in a casino?
The research methodology addresses that exact friction. You do not have to trade Tier 4. In fact, most institutional quantitative funds have strict mandates forbidding their algorithms from touching anything outside of Tiers 1 and 2, purely to preserve capital and ensure execution quality.
So why does the research insist we use them in our validation process?
Because you aren't testing them to trade them, you are testing them to break your logic. You need to see if your algorithm's core premise holds up when the environmental variables change radically.
Oh, I see.
Think about the correlation issue. In Tier 1, an asset's correlation with Bitcoin might be 0.95. In Tier 3 or 4, it might be 0.3. If your brilliantly optimized Ethereum strategy secretly, mathematically relies on just following Bitcoin's momentum, which is a really common flaw, it will look like a genius in Tier 1.
But when you force it to trade Tier 3,
Right, where Bitcoin's gravity doesn't exist, the strategy will instantly collapse.
it exposes the hidden dependencies.
Exactly. Validating across these chaotic tiers is a stress test. You are dropping your algorithm into a hostile, alien environment, not because you want it to live there, but because if it can survive a week in the jungle, it proves the code is actually robust, independent, and structurally sound.
Okay, I see the vision. It's a crucible. So how do we actually run this crucible? The source material lays out a very specific sequential pipeline for conducting multi-symbol validation. I want to walk through the steps, but I don't want to just list them. I want to know the why behind the sequence.
Fair enough. Let's start with step 1.
What do we do first?
The first step in the pipeline is to establish your baseline. You optimize your strategy on a single primary symbol. You choose your battleground. Let's say you pick Ethereum.
Yeah.
You run your parameter search to find the most efficient mathematical combinations. You conduct your plateau analysis to ensure those parameters are stable. You run your walk-forward testing to ensure it survives through time. Basically, you spend weeks building the absolute best possible Ethereum strategy you can.
Okay, and once I find that perfect setup with the 55% return?
You lock it in. The parameters become fixed. You are no longer allowed to tweak the moving average lengths. You cannot touch the stop-loss percentages. The optimization phase is permanently closed.
The concrete has dried. Where do I deploy it next?
Step 2 is to test the strategy on other symbols that reside within the same tier. You take those strictly unchangeable parameters and you run them on 5 to 10 other assets that share the same microstructure.
So sticking with the neighborhoods.
Exactly. Now, if you started in tier 1 with Ethereum, you are basically limited to testing it on Bitcoin. But if you happen to build a strategy optimized for Solana in tier 2, you would test it against Binance Coin, Cardano, Avalanche, and others in that specific group.
Why do this before moving to the wilder tiers?
Because if a Solana optimized strategy fails when applied to Cardano, an asset with remarkably similar volatility, liquidity, and macro drivers, then the strategy is fundamentally broken.
Oh yeah, that makes total sense.
It means it's hyper-fitted to Solana's specific candlestick noise. There is zero point in testing it on Dogecoin if it can't even survive its own neighborhood.
It's the first filter. Assuming it passes, then we go off-roading.
Right. Step 3 is the real trial. You take those exact same locked parameters and test them on symbols from other tiers. You run the ETH strategy on 3 to 5 symbols from tier 2, another group from tier 3, and perhaps a few from tier 4. You are forcing the algorithm to deal with shifting volatility, thinning liquidity, and completely different market drivers.
And if it survives that?
If a strategy is deeply profitable on Ethereum in tier 1 and somehow manages to generate consistent profits on Arbitrum in tier 3 without you changing a single line of code, the mathematical probability that you merely curve-fitted your strategy to historical noise becomes astronomically low. You have found a true inefficiency in market mechanics.
But survival isn't just a binary yes or no, right? Step 4 is the analysis phase. When I'm staring at the results of 30 different backtests across 4 tiers, what am I actually looking for to determine if I succeeded?
You aggregate the performance metrics by group to assess cross-symbol robustness. For every token tested, you log the total profit and loss, the maximum drawdown, the total number of trades executed, the win rate, and a crucial metric called P&L per active day.
P&L per active day.
Yeah, it basically measures how efficiently the strategy uses capital when it is actually exposed to the market. And the research establishes strict, non-negotiable pass criteria based on these exact metrics.
Let's hear the rules. What constitutes a pass?
First, the strategy must be profitable on at least 60% of the symbols within its own home tier.
Okay, pretty straightforward.
Second, the aggregate average P&L across that home group must be strictly positive. Third, and this is where many strategies fail, the maximum drawdown on the other symbols cannot increase catastrophically. As a rule of thumb, the drawdown in a foreign tier shouldn't exceed 2 to 3 times the drawdown of your optimized symbol.
Ah, okay. So if my ETH drawdown was 2%, it's acceptable if my Dogecoin drawdown hits 6%. But if it hits 40%, the system is fundamentally broken.
Exactly. The degradation must be mathematically proportional to the increase in environmental risk. And finally, the ultimate deal breaker. If the strategy is only profitable on the single symbol you originally optimized it on, it is an instant, unceremonious rejection. You delete the code and start from scratch.
Man, this framework sounds incredibly harsh. But I want to see the actual devastation it causes. The source material provides 3 concrete case studies of what happens when a developer takes an Ethereum-optimized strategy and forces it through this exact pipeline.
Yes, let's look at those.
Let's dig into the mechanics of these examples because this is where theory meets reality. Talk to me about strategy A.
Strategy A is the classic acceptable but limited system. During the step 1 optimization on Ethereum, it looks phenomenal. It generates a plus 55% P&L. The maximum drawdown is an incredibly safe negative 0.9%. It executes hundreds of trades, and the win rate sits comfortably at 52%.
It's the dream algorithm from the beginning of our deep dives.
Right. So we move to step 2. We test it across Tier 1 and Tier 2 assets, and it performs reasonably well. On Bitcoin, it yields a plus 31% return. On Solana, it returns 22%. Out of the 6 blue chip and large cap coins tested, it remains profitable on 5 of them.
Solid.
Very solid. The average return across Tier 1 is 43%, and across Tier 2, it's a respectable 11%.
It passes the home tier filter with flying colors. It seems completely robust.
But then step 3 pushes it into the mid-caps.
Yeah.
We pointed at Doge, Shiba Inu, Pepe, Arbitrum, and the engine completely seizes up. The strategy is unprofitable on every single one of the 5 Tier 3 coins tested.
Every single one.
All of them. It bleeds nearly 25% of its capital on PEPE and loses 19% on ESHIB. The average P&L in Tier 3 plummets to negative 13.7%, and the average drawdown violently spikes past 10%.
Yikes. So as an algorithmic manager, how do I interpret that failure? Do I throw strategy A away?
Not necessarily, but you must drastically recalibrate your understanding of what you've built. The validation pipeline revealed that strategy A is highly specialized and deeply dependent on a low volatility, high liquidity environment.
Oh, because it couldn't handle the chaos of Tier 3.
Exactly. It relies on the tight spreads of Tier 1 to execute its specific logic. If your institutional mandate is to only ever trade blue chips, strategy A is perfectly viable. But if you deluded yourself into thinking you discovered a universal law of algorithmic trading, the pipeline just proved you wrong.
It's a luxury sports car. It drives beautifully on a freshly paved track, but the second you hit gravel, the suspension just snaps.
That's exactly it.
That brings us to strategy B.
Yeah.
In the research notes, strategy B initially looks like a complete disappointment compared to A.
It does. During the single symbol optimization phase on Ethereum, strategy B only manages to eke out a 25% P&L. The maximum drawdown is noticeably higher at negative 2.3%. And it only executes about 40 trades over the entire period, meaning it's a very slow, highly selective strategy.
So it's not flashy at all.
Not at all. And human psychology plays a huge role here. Most developers would stare at a 25% return, compare it to strategy A's 55%, and just toss strategy B in the recycling bin.
Because we are hardwired to chase the highest theoretical yield on the dashboard. But why is throwing strategy B away a catastrophic mistake?
Because when you run strategy B through the multi-symbol pipeline, its true nature is revealed. It is solidly profitable on both Tier 1 assets. It is profitable on all 4 of the Tier 2 assets tested. And, incredibly, it manages to remain profitable on 3 out of the 5 highly chaotic Tier 3 assets.
Wait, it actually survived the wildlands?
It did. It boasts an 82% profitability rate across the entire spectrum of symbols tested. Yes, the raw returns are lower, and yes, the maximum drawdown naturally increases as it moves into the riskier tiers, hitting around negative 7% in Tier 3. But that degradation is entirely proportional. It doesn't blow up. It just absorbs the risk gracefully.
So strategy B is the actual holy grail. It possesses a genuine mathematically demonstrable edge that transcends the underlying asset.
Exactly. Strategy B builds generational wealth because it relies on market truth, not historical noise.
Which perfectly sets the stage for the nightmare scenario. Strategy C. The research literally calls this type of system a capital destroyer.
Oh, strategy C. It is the embodiment of everything wrong with retail algorithmic trading. During optimization on Ethereum, the backtest prints a staggering plus 301% return.
300%.
Right. It fires off over 400 trades. The drawdown is steep, 17%. But a developer looking at a 300% gain will easily rationalize a 17% dip.
Honestly, yeah, it's the golden goose. You'd be tempted to leverage your house to trade this.
And then you test it on Bitcoin. The return instantly plummets from 300% down to 42%, and the drawdown plunges to 28%.
Okay, a huge drop in performance, but technically, 42% is still a profit. You might convince yourself it's just a rough patch.
But then you push it into the altcoins. You test it on Solana. It loses 18% of the account with a 41% drawdown. Avalanche. Negative 31%, 52% drawdown.
Oh my God.
And then you throw it into the meat grinder of Tier 3. On Dogecoin, The strategy annihilates 67% of the capital, suffering a 74% maximum drawdown.
It's just falling apart.
It gets worse. On PPE, it loses 72% with an agonizing 81% maximum drawdown.
It just systematically vaporizes the portfolio.
It is the textbook definition of catastrophic instrument-level overfitting. The algorithm didn't find an edge. It just perfectly memorized every single quirk, wiggle, and anomaly of Ethereum's price history. When presented with data it hadn't memorized, it was completely blind and mathematically defenseless.
But wait, this is where my brain gets stuck. I understand the concept of overfitting. I understand that it fails, but I want to know why it fails so violently.
Let's get into it.
Like, when Strategy C's code hits PEPE, what specific mechanical gear in the algorithm is grinding to a halt and causing an 80% drawdown? It can't just be magic.
It's not magic, it's structural incompatibility, and that bridges us directly into understanding the mechanics of failure. Why do seemingly excellent strategies turn into account destroyers when crossing tiers? The source material unpacks 4 highly specific mechanical reasons for this breakdown.
Okay, let's do it.
Let's start with the most lethal one, volatility mismatch.
How does volatility literally break the code?
Well, every quantitative strategy relies on parameters that act as mathematical thresholds. Entry triggers, stop-loss limits, trailing take profits. During optimization, these thresholds are hyper-tuned to the specific background volatility of the primary asset. Let's say strategy C was optimized on Ethereum to use a strict 1% stop loss.
Okay, so if the trade goes against me by 1%, the algorithm aborts the mission and sells to protect my capital.
Right. And for Ethereum, which has an average daily volatility of roughly 3%, a sudden 1% move against your position is a highly meaningful statistical signal. It indicates that the local trend has genuinely reversed, and the stop loss correctly filters you out of a bad trade. The threshold matches the environment.
But Pepe doesn't move like Ethereum.
Exactly. Pepe might have a daily volatility of 8, 10, or even 12%. It is violently erratic. On Pepe, a 1% price movement is literally just background noise. It's the market breathing in and out.
Oh, I see where this is going.
So if you apply that exact same rigid 1% stop loss to Pepe, your algorithm is going to get triggered by completely meaningless micro-fluctuations. It will enter a trade, get immediately stopped out by random noise, re-enter, get stopped out again. It will do this dozens of times a day, bleeding your account dry through 1,000 tiny mathematically guaranteed cuts.
That makes perfect sense. You're trying to use a delicate surgical scalpel to chop down a redwood tree. The tool is utterly mismatched to the material. What is the second mechanical failure point?
Liquidity differences, which primarily manifest as devastating slippage.
Let's really unpack slippage, because I feel like backtesting software constantly lies to us about this.
Oh, it absolutely does. When you run a backtest for strategy C on Ethereum, the testing engine assumes you achieve instant perfect execution at the exact historical price you requested. If the chart says Ethereum was at $3,000, the backtester assumes you bought it at exactly $3,000.
Which, in Tier 1, is somewhat realistic, right?
Mostly, yes, because Tier 1 order books are incredibly deep. You have $50 million of resting limit orders clustered tightly around the current price. If your algorithm fires a $10,000 market buy order, the market absorbs it effortlessly. You get your exact price without disturbing the ecosystem.
But what happens when Strategy C fires that exact same $10,000 market order into the thin liquidity of a Tier 3 altcoin?
Disaster. In Tier 3, the top level of the order book might only contain $2,000 worth of resting orders. When your $10,000 buy order hits the exchange, it instantly consumes that $2,000, and then the matching engine violently rips upward through the next price levels, desperately searching for sellers to fill the remaining $8,000.
Whoa.
Your single order actually moves the market price against yourself.
Think about it like parking a vehicle. If Tier 1 is an empty, massive stadium parking lot, your $10,000 order is a tiny sports car. You just glide right in, no friction, no problem.
Perfect analogy.
But Tier 3 is a narrow, packed, one-way alleyway. If you try to aggressively wedge that same order into that alley, you are going to violently scrape the paint off every single car parked on the street. And that's structural friction, that scrape, that is the slickage physically eating your profit margin.
And while a 0.2% slippage on a single trade might not sound terrifying, remember that strategy C executes hundreds of times. Over 500 trades, that tiny structural tax compounds relentlessly. The research explicitly notes that in lower liquidity tiers, slippage alone can consume anywhere from 25 to 100% of a strategy's theoretical backtested profits. The strategy literally crushes itself under its own weight.
Okay, so volatility stops us out prematurely, and poor liquidity grinds away our margins. What's the third mechanical killer?
Market microstructure variables. This involves the underlying mechanics of the exchange itself, specifically funding rates and bid-ask spreads. Let's look at funding rates on perpetual futures contracts. Funding is the mechanism exchanges use to force the futures price to stay tethered to the actual spot price. If the market is overwhelmingly bullish, the people holding long positions have to pay a continuous fee to the people holding short positions.
To incentivize balance.
Right. On a tier 1 asset like Bitcoin, that funding rate is generally very small and predictable, maybe 0.01% every 8 hours. A well-designed algorithm can easily model and absorb that slow, steady drag on profitability. But when you move to the meme coins in tier 3, the funding rates become entirely unhinged.
Unhinged.
They can swing violently from negative 0.3% to positive 0.5% in a matter of hours as retail crowds frantically pile into one side of a trade.
Wait, so if my algorithm decides to hold a long position on a meme coin for 3 days because the technical indicators look good, the underlying funding fees alone might entirely wipe out the profit margin before the trade even closes.
Exactly. The cost of carrying the position destroys the mathematical edge, and the same structural barrier applies to spreads. On Tier 1, the gap between the highest buyer and lowest seller is practically zero. But on Tier 4, the spread itself might be a massive 0.5% gap. If your high-frequency algorithm is designed to quickly capture small 0.4% price movements,
You are mathematically guaranteed to lose money on every single trade because the physical gap you have to cross just to enter the market is larger than your target profit. The microstructure physically prohibits the strategy from functioning.
which brings us to the fourth and final mechanical reason for failure: regime sensitivity. This is perhaps the most insidious because it involves macroeconomic cycles. Altcoins do not just linearly follow Bitcoin's exact path at all times. Their behavioral relationship fundamentally shifts depending on the broader market regime.
You mean the difference between a bull market, a bear market, and a sideways chop?
Precisely. In a violent, euphoric bull market, altcoins typically exhibit a high beta relative to Bitcoin, meaning if Bitcoin goes up 5%, the altcoins might rocket up 15%. But in a grinding, brutal bear market, that relationship fractures. Altcoins will fall drastically harder and faster than Bitcoin, and their recoveries will lag significantly.
So how does that destroy a backtest?
Imagine you optimized your Ethereum strategy during the massive bull run of 2021. The machine learning optimizer analyzed the data and discovered a specific, highly profitable mathematical relationship between how Ethereum lagged behind Bitcoin's breakouts and then violently caught up. The algorithm tunes all of its parameters to perfectly exploit that specific lead-lag dynamic.
But doesn't realize that dynamic only exists when interest rates are zero and retail euphoria is at a peak.
Exactly. The algorithm believes it has discovered a permanent law of physics. But when the macro regime shifts into a bear market, that lead-lag relationship completely evaporates. Ethereum starts behaving entirely differently relative to Bitcoin, but your locked algorithm is still blindly firing trades based on a mathematical ghost that no longer exists in the new regime.
Okay, this is all incredibly illuminating, but it puts us as developers in a deeply frustrating paradox. If the environment is shifting this drastically between tiers like the volatility is wilder, the liquidity is thinner, the spreads are massive, how could we possibly fairly validate an algorithm across these different coins without being forced to entirely rewrite the core parameters for every single asset?
Right.
Because if we just apply the ETH parameters blindly to DOGE, we know it will fail due to volatility mismatch.
This is the exact crux of the validation problem, and it brings us to a highly elegant mathematical solution proposed in the research: adaptive parameter scaling.
Because simply running identical rigid parameters everywhere is clearly illogical.
Right. As we establish, a 1% stop loss on Ethereum is mathematically meaningless on Dogecoin. But the trap developers fall into is thinking, okay, I will just run a completely new parameter optimization specifically for Dogecoin to find the perfect stop loss for that coin.
Wait, if I do that, I've entirely defeated the purpose of cross-symbol validation. I'm no longer testing my original core logic to see if it survives. I'm just creating a brand new, custom-tailored, curve-fitted strategy specifically for Dogecoin.
Exactly. Re-optimizing turns validation into just another overfitting exercise. The parameters become native to the new symbol, and you learn nothing about the universality of your edge.
So what is the middle ground? How do we adapt the suit to fit the wearer without fundamentally changing the fabric of the strategy?
The compromise is parameter normalization by volatility. The concept is brilliant in its simplicity. You do not change the underlying structural logic of the strategy, but you mathematically scale the rigid price thresholds to proportionally match the background volatility of the new environment.
Okay, I need to understand the mechanics of this. Walk me through the actual math. Let's stick with our Ethereum and Dogecoin example.
Let's say your perfectly optimized Ethereum strategy utilizes a rigid 1% trailing stop loss. Before you test it on Dogecoin, you must first calculate the historical baseline. You look at the data and determine that Ethereum has an average daily historical volatility of exactly 3%.
Okay, our baseline is 3.
Now, you analyze the target asset. You look at Dogecoin's historical data over the same window, and you calculate that its average daily volatility is significantly higher, sitting at 8.1%.
Considerably more chaotic.
So you apply a simple scaling formula. You take the ratio of the two volatilities. You divide Dogecoin's 8.1 by Ethereum's 3. That gives you a mathematical multiplier of exactly 2.7. You then take your original 1% stop loss and multiply it by that 2.7 ratio.
So the stop loss parameter for the Dogecoin test automatically scales up to 2.7%.
Roughly, yes. The exact math in the source's case study actually scales it to 2.53% based on a slightly different historical look-back window. But the underlying principle is identical. By mathematically scaling the threshold, you guarantee that the underlying meaning and intent of the stop loss remains perfectly preserved across both assets.
Wow, that's clever.
On both Ethereum and Dogecoin, the stop loss now represents the exact same standard deviation of expected price movement. You have neutralized the volatility mismatch without altering the logic.
That is genuinely brilliant. It dynamically absorbs the shock of the new environment. But I have to ask about limits. Do I just scale every single number in my code? What if my strategy uses a 14-period relative strength index or a 50-period moving average? Do I multiply the length of my RSI by 2.7 so it becomes a 37-period RSI on Dogecoin?
That is the single biggest mistake developers make when attempting this, and getting this wrong will permanently corrupt your validation. You absolutely never scale indicator periods. You only ever scale absolute price thresholds, meaning entry triggers, stop losses, and specific take-profit distance targets.
Wait, why wouldn't I scale the length of a moving average to match the volatility? Doesn't the indicator need to adapt too?
Think about the internal mechanics of how an indicator is actually calculated. A 14-period relative strength index, or RSI, is already naturally mathematically normalizing volatility internally. It calculates recent momentum relative to the recent price action. It inherently accounts for whether the recent swings have been massive or tiny.
Oh, I hadn't thought that.
A 50-period moving average is already dynamically smoothing out the specific volatility of whatever asset it is applied to.
Ah, so the indicators are already doing the heavy lifting.
Exactly. They are self-normalizing. If you attempt to manually scale the look-back period of an RSI based on external volatility, you are essentially double adjusting the data. You will completely shatter the underlying math of the signal, rendering the indicator totally meaningless. Leave the indicator periods locked, only scale the rigid price boundaries.
Okay, that is a massive, incredibly vital pro tip. Only scale the boundaries. But this leads me to a clarifying question about the testing protocol itself. The research explicitly mentions that developers should run the validation pipeline in 2 parallel modes, a strict mode and an adaptive mode.
Right.
If we just spent all this time proving that mathematically scaling the parameters by volatility is the only intelligent way to test across tiers, why on earth does the research suggest we should still bother running a strict mode test where we stubbornly refuse to scale anything?
Because they are interrogating the strategy from 2 fundamentally different philosophical angles. The research recommends running both because they answer 2 distinct questions about the nature of your edge.
Let's pull those apart. What is the brutal, unscaled strict mode actually testing?
Strict mode is a test of absolute, raw, uncompromising robustness. It is an incredibly punishing standard. When you force a strategy to trade Dogecoin using a stop-loss tuned for Ethereum's low volatility, the friction is immense. If a strategy can somehow survive strict mode and remain profitable despite those massive structural disadvantages, it means the core mathematical edge is so overwhelmingly powerful and fundamentally universal that it can quite literally overpower the friction of the environment.
Wow.
It proves the pure raw strength of the underlying concept.
It's like a runner winning the mountain race while still wearing their flat indoor track shoes. It proves they are just an absolute freak of nature. So what does the adaptive mode tell us?
Adaptive mode, where we utilize the volatility scaling math we just discussed, is a test of the strategy's logic in practical logical deployment. It asks the question: if we intelligently adjust the parameters for the obvious, undeniable environmental differences, does the foundational thesis still hold true? Strict mode proves the raw theoretical strength. Adaptive mode proves the logic is genuinely sound for real-world application.
Okay, I have run the gauntlet. I have executed the full pipeline. I have my locked parameters. I have tested across the 4 distinct tiers. I have run both strict and adaptive modes. And now I am staring at an absolute mountain of data.
It gets overwhelming fast.
Seriously, I have spreadsheets containing P&L numbers, drawdowns, active days, and win rates for 30 different tokens. How do I objectively make sense of this? Because humans are terrible at looking at massive data sets without lying to themselves.
Human confirmation bias is the silent killer of algorithms. If you just stare at the raw data, your eyes will naturally gravitate toward the 3 volatile altcoins where the strategy printed a massive 50% return, and your brain will conveniently ignore the 7 other tokens where the strategy slowly, quietly bled out 20% of its capital.
Guilty as charged.
To eliminate human psychology from the equation entirely, the source material introduces a rigorous composite mathematical metric.
We need a final grade.
Yeah.
And this is the cross-symbol robustness score, the CSRS.
Correct. The CSRS is a single objective number that grades the true underlying universality of your algorithm. It distills the mountain of data into a clear verdict, and it calculates this score by weighting 4 very specific, distinct components of performance.
I want to break down this formula so we understand exactly what it values. What is the heaviest weighted component of the grade?
35% of the total final score is dictated by the fraction of profitable symbols. This is a remarkably simple, blunt mathematical reality check. Out of all the diverse symbols you subjected to the test, what strict percentage of them ended up with a positive P&L?
So it's essentially asking, does this logic work on the vast majority of things you throw it at, regardless of the tier?
Exactly. The research considers this the most vital baseline factor. If your strategy manages to make a staggering fortune on 2 specific meme coins, but it loses money on 8 other solid assets, it is fundamentally not robust. The math demands universality, not isolated luck.
Okay, 35% is pure, broad consistency. What makes up the next chunk of the score?
25% of the score is determined by what the research calls normalized liquidity-weighted average P&L.
That sounds like something a hedge fund quant says just to sound intimidating. Let's translate that into plain English.
It basically means we look at the absolute financial returns, how much actual money the strategy generated across the entire portfolio of tested coins. But we aggressively adjust the value of those returns based on how physically easy it is to actually execute trades on those specific coins in real life.
Oh, wow. So if my backtest claims I made $1 million trading some tiny illiquid Tier 4 microcap token, the formula actively devalues that profit compared to $1 million made trading Bitcoin.
Precisely. Because the formula mathematically recognizes that the $1 million profit on the tiny Tier 4 coin is almost certainly an illusion generated by the backtesting engine, ignoring slippage and order book depth. Whereas the $1 million made on Bitcoin is a highly realistic, bankable profit because the Tier 1 liquidity is deep enough to actually absorb your orders without moving the market.
That is amazing.
The liquidity weighting severely penalizes strategies that rely on the paper profits of illiquid, untradeable markets.
I absolutely love that. It brutally enforces reality onto the backtest. It stops you from lying to yourself about how rich you'd be if you could just magically trade perfectly in a vacuum. All right, so that covers 60% of the score. What accounts for the next 25%?
25% is awarded as a bonus for cross-tier consistency. The formula grants significant extra weight if your strategy mathematically proves it can generate consistent profit across fundamentally different microstructural environments.
So a strategy that is moderately profitable in Tier 1, Tier 2, and Tier 3 gets a significantly higher robustness score than a strategy that is wildly profitable, but only functions inside the safe confines of Tier 1 and Tier 2.
Yes. It rewards the algorithm for demonstrating genuine adaptability and universal logic rather than environmental dependence.
Okay, we have 10% remaining to make up the full CSRS formula. What is the final component?
I apologize, let me correct the math there. The previous components were 35, 25, and 25. That leaves a final 15% of the score. And this final 15% is incredibly unique because it is entirely punitive. It is a strict mathematical penalty applied for high P&L variance between the tested symbols.
Wait, I really need to unpack this variance penalty because the implications of that are profound. What that means practically is that if my algorithm returns a staggering, incredible 100% profit on Dogecoin, but then loses a tiny 2% on 5 other stablecoins, the formula doesn't celebrate the massive Dogecoin win. It actively flags the massive disparity in those results and punishes the final score.
That is the exact intent of the penalty. The formula hates instability. It severely punishes extreme outliers. It mathematically forces the algorithm to behave as a steady, reliable, consistent worker across the entire portfolio, rather than rewarding it for being a volatile one-hit wonder that just happened to get lucky on a single explosive asset.
It demands an edge, not a lottery ticket. So once the algorithm crunches all the fractions, the weights, and the penalties, what does the final output look like? How do we read the grade?
The output is a normalized decimal number, typically scaling between 0 and 1. If your strategy achieves a score over 0.7, that indicates excellent, undeniable robustness. It means the strategy confidently executes its logic across the vast majority of instruments and tiers, regardless of the environmental friction.
That's the golden ticket.
A score landing between 0.5 and 0.7 is considered good, but requires caution. It indicates the strategy likely functions incredibly well within its optimized home tier and demonstrates acceptable, albeit degraded, survival skills when pushed into foreign tiers.
And what if it's lower?
A score between 0.3 and 0.5 is borderline dangerous. It reveals the strategy is likely only functioning on a very narrow, highly correlated set of specific symbols.
And if the score prints under 0.3?
If the score is under 0.3, it indicates exceptionally low robustness. The strategy is almost certainly suffering from severe terminal instrument-level curve fitting. The research is unambiguous. Under no circumstances should you deploy real capital to a strategy scoring under 0.3.
This entire framework, the tiers, the pipeline, the adaptive scaling, the CSRS score, it feels incredibly robust. It feels like a bulletproof vest against the single symbol trap. But I have to play the skeptic for a moment.
Go for it.
Are there any scenarios, any weird corners of quantitative finance where a developer should look at this entire massive methodology and logically say, you know what, this multi-symbol validation doesn't apply to my work. I'm perfectly justified in only ever looking at one single symbol.
That brings us to a vital clarification in the research. The authors are very clear that multi-symbol validation is a tool, not a blanket religious dogma. There are 3 highly specific, mechanically justified edge cases where a single symbol strategy is not only acceptable, but where attempting multi-symbol validation would be scientifically and mathematically incorrect.
Let's outline the exceptions. What is the first scenario where I can ignore all of this?
High-frequency market making. If you are deploying a market-making algorithm, for instance, a system built on the classic Avellaneda-Stoikov mathematical model, your entire strategy is deeply, inextricably fused to the physical, microscopic reality of one singular order book.
Wait, let's explain what that actually means mechanically for the listener who isn't a quant. What is the algorithm physically doing?
A market-making algorithm is simultaneously placing buy orders slightly below the current price and sell orders slightly above it. It isn't trying to predict if the asset will go up or down over the next week. It is simply trying to capture the tiny fraction of a percent difference, the spread between the buyers and the sellers, thousands of times a day.
Yeah, I follow.
To do this successfully, the algorithm's parameters are hyper-tuned to the exact millisecond by millisecond depth, the historical bid-ask spread, the latency of the exchange server, and its exact queue position within, say, the BTC USDT order book on Binance.
So the algorithm is essentially playing a hyper-fast, incredibly specific game of Tetris with the matching engine of that exact exchange, trying to test that specific logic on Dogecoin. It would be like taking a subway train engineered for a specific underground track and trying to drive it on a dirt road. The physical environment the machine was built for simply does not exist there.
Precisely. The order books are entirely distinct physical environments. Cross-testing a market maker is mathematically meaningless. The second explicit exception is arbitrage strategies.
Right. Algorithms that hunt for price discrepancies.
Whether you are running a funding rate arbitrage algorithm or a cross-exchange spot versus futures arbitrage, the core logic of the strategy is, by definition, mathematically locked to the specific historical relationship between two exact trading pairs. If you build an algorithm designed to capture the microscopic price differences between Bitcoin trading on Binance and Bitcoin trading on Coinbase,
it makes absolutely zero logical sense to test that algorithm's performance on Ethereum. Because the algorithm isn't trading the concept of cryptocurrency, it is trading the explicit structural inefficiency between those two specific Bitcoin servers. The validation for an arbitrage strategy occurs by evaluating other exchanges, not by arbitrarily testing other symbols.
that is exactly correct. And the third and final exception involves strategies that are explicitly constructed around a fundamentally unique physical or digital property of a specific asset. For example, imagine you build a highly predictive strategy that trades Bitcoin strictly based on its historical mathematical correlation with global mining hash rate data or specific on-chain miner wallet movements.
Well, Ethereum moved to proof of stake. It doesn't even use mining hash rate anymore, so that fundamental data point literally does not exist for other coins.
Precisely. If the fundamental structural driver of the mathematical edge is physically or technologically unique to a single asset, attempting multi-symbol validation is literally impossible because the necessary variables don't exist anywhere else.
But let's be honest, those are incredibly narrow, highly specialized institutional edge cases.
They are extremely narrow. The research emphasizes a brutal, hard rule for the vast majority of developers. If your algorithm utilizes generic, universal market signals moving averages, relative strength index, momentum oscillators, Bollinger Bands, or standard mean reversion logic, then multi-symbol validation is absolutely non-negotiable.
You have to do it.
If a strategy built on standard technical indicators only manages to generate profit on one single symbol, you have not discovered a market edge. You have simply engaged in complex, mathematically obfuscated overfitting.
Wow. Okay. To wrap up this incredibly deep dive, the source material does something really powerful at the end. It takes this entire concept of multi-symbol validation and slots it into a much broader, holistic context. It presents it as the final, critical pillar of what we might call the holy trinity of out-of-sample quantitative testing.
Yes. The three orthogonal, entirely independent axes of algorithmic validation. If you want to survive the markets, you must conquer all three.
Let's synthesize this entire massive stack of research for the listener right now. If you want to avoid the absolute devastating nightmare of the illusion of a perfect backtest, you cannot afford to look at your strategy from a single narrow angle. You must ruthlessly, systematically attack your algorithm from three distinct dimensions.
First, you deploy walk-forward validation. You slice your data into distinct training and testing windows. This tests the axis of time. It mathematically proves you haven't just memorized the specific static historical period of the 2021 bull run.
Second, you deploy the Monte Carlo bootstrap. You violently randomize the chronological sequence of your executed trades, simulating thousands of alternate realities. This tests the axis of trade order. It mathematically proves your strategy isn't merely dependent on a miraculously lucky sequence of coin flips to survive its drawdown periods.
And third, the entire focus of today's exploration, multi-symbol validation. You force the strategy out of its home environment and subject it to varying tiers of volatility, liquidity, and microstructure. This tests the axis of the instrument. It mathematically proves you haven't just curve-fitted your core logic to the unique, erratic personality of a single asset.
If and only if your algorithm survives the grueling test of time, survives being battered by a randomized sequence of chaotic trades, and survives being deployed into the alien, hostile environments of completely different instrument tiers, then you can finally stop holding your breath. Because then you actually possess a real, viable, statistically robust trading strategy.
A strategy that genuinely passes all three of those rigorous checks possesses a statistically minimal probability of being an artifact of overfitting. It is the closest thing to objective truth you can ever hope to find in quantitative finance.
So, circling all the way back to the scenario we started with. You are sitting at your desk, you have that perfectly optimized strategy printing a 55% return on Ethereum. What do you actually do? You don't open the champagne, you don't connect your live exchange API keys, you take a breath and you run it through the multi-symbol pipeline.
Right.
Because the ultimate unassailable takeaway from all this research is that a strategy that only works on one symbol hasn't found a secret edge. It has merely memorized a sequence of numbers. A lower return, like strategy B's 25%, paired with a high CSRS robustness score, is infinitely better, mathematically safer, and vastly more valuable in the long run than a massive 300% return that relies on being perfectly, precariously balanced on the noise of the past.
You know, before we close out, contemplating this entire methodology actually raises a really provocative, almost philosophical thought based on something buried at the very end of the source material regarding what they call cascade
Oh,
strategies.
man.
We've spent this entire time discussing how to rigorously filter and discard strategies until we find the one perfect universal algorithm that survives across all tiers. But if the validation process empirically proves to us that different algorithms naturally possess fundamentally different robustness profiles, for instance, strategy A consistently thrives in the low volatility of tier 1, while a completely different strategy thrives on the chaos of tier 3.
Right. They all have their strengths.
So what if the holy grail of algorithmic trading isn't actually about building one single monolithic god strategy that works on everything?
Okay, my mind is spinning a bit. Where are you going with this? What is the alternative?
What if the ultimate mathematically unbeatable edge is actually building an orchestrator AI? A meta-algorithm that doesn't actually execute trades directly itself. Instead, its only function is to constantly observe the shifting macroeconomic regime of the crypto market, analyze the real-time volatility and liquidity tiers, and then dynamically rotate and deploy a massive portfolio of completely different, highly specialized microstrategies to specific tiers at exactly the right times.
Oh, wow. So instead of trying to train one single runner to somehow win a flat sprint, a mountain climb, and a swimming race, you build a manager who constantly reads the weather forecast and dynamically swaps in the sprinter for the flat track, immediately recalls them when it starts raining, and deploys the mountaineer for the hills entirely in real time. That completely changes the paradigm. You stop fighting the environment and start using the environment as the signal itself. That is a completely different way to look at the geometry of the market. And definitely something for everyone listening to chew on the next time they sit down to write some code. Thanks for taking this deep dive with us. We'll see you next time.